afternoon. Thank you for joining us today. I know that the Fed announcement might be imminent, but we appreciate you spending the time with us. Thanks for joining us for this ETF shorting strategies from hedging to hedge funds. This will be a 1-hour webinar, and we're grateful for the sponsorship of the ProFunds Group. My name is Dave Noddig, and I'll be your host for today's webinar. I'm the Director of Research here at indexuniverse.com, as well as the Journal of Indexes and the Exchange Traded Funds Report, which is the longest-running ETF-focused newsletter in the world. The format for the afternoon is pretty straightforward. I'm going to do a short 20 to 30-minute presentation discussing some of the basic strategies of the short seller. But perhaps more importantly, we're going to try to address really what the big question is, which is why go short in the first place? What value does inverse market exposure bring to you as an advisor or as an individual investor? Beyond that, we'll take a look at some of the strategies used by sophisticated investors, institutional investors, and individual investors to hedge portfolios, to manage risk, to generate excess returns. And last, we're going to walk through some of the tools of the trade. We'll touch briefly on some of the various ways you can achieve different patterns of short returns. We'll look at the pros and cons of everything from options to inverse funds and inverse ETFs. We'll talk about how to evaluate some of the benefits of different approaches, and we'll review some of the potential pitfalls that you should probably be aware of. At the end of my presentation, I'm going to bring in our esteemed panelists, and we'll open things up for audience Q&A. Joining me on the panel today will be 3 experts in evaluating short strategies with very different perspectives. Joanne Hill is the head of investment strategy for the ProFunds Group and author of several recent studies on leveraged and inverse ETFs, some of which have been featured in the Journal of Indexes. Tim Collins is the founder and principal at Tangle Trade Management, and you all may know him as a frequent contributor at TheStreet.com, where he sometimes served as a foil to James Cramer. And we have Rob Stein, who's the portfolio manager for the Aster Long Short ETF Fund, obviously a very relevant product in our discussion. And he's also the editor of ETFport.com. A few housekeeping items. As a participant in this webinar, you can submit questions at any time during the presentation by entering them in the Q&A window, which should be on the right-hand side of your screen. We'll collate as many of those questions as we can and answer as many as we can during the Q&A session at the end. A replay of this presentation and copies of the slides will be available at our website, indexuniverse.com, within a day or two. And for those of you interested in continuing education credits, information on how to apply for those credits is available on the last slide of this presentation, which we'll leave up for a while so people have a chance to write that down. That information will also be in a follow-up email. With that, let's go ahead and get started. So first off, let's just lay a little bit of groundwork. So what do we mean when we say going short? So some people, that definition is really rather rigid. And technically, you really are only going short when you sell a security that you don't actually own by borrowing it from somebody who does own it. But with increased options available to investors, I like to think of going short in a less rigid fashion. So I think of going short as taking any position in your portfolio or really making any investment decision at all that's designed to profit from the decline of a particular security or a particular market or a particular index. In short, it's really any strategy or any tactic that inverts the classic buy and hold mentality. So up becomes down and down becomes up. Now, this isn't really a new idea at all. And I think a little bit of history is worth pointing out because I think a lot of people still see shorting as sort of arcane and fringe. But you know, back the very first stocks that were traded, the Dutch East India Company was also the first company to file a complaint against the exchange because people were making a killing shorting their stock. And in fact, that interplay between short sellers and exchanges really is something that tracks the entire history of short selling. It's all about this trade-off between innovation and regulation. You know, on the regulation side, it's been a pretty consistent refrain from governments and from public companies as well that short selling somehow distorts markets. And in fact, there are some practices that could distort markets. You know, completely unfettered, naked short selling, just people selling share after share of something that they don't own, can't possibly get, can't borrow, and have no intention of getting, would obviously have deleterious effects on the market. And in fact, some of the earliest regulations were outright bans on that kind of practice. And here in the U.S., obviously, short selling regulation is constantly in the papers. It's something that does come up on a frequent basis. But I think alongside that, it's also worth pointing out that the market continues to find innovative ways to provide what is truly an extremely useful investment tool, the ability to get short exposure. Those innovations go back to things like the very first hedge funds in 1949 that began creating market-neutral portfolios, offsetting their long positions with short positions. And that innovation really has continued right to today. In 1993, we saw the launch of the first mutual funds designed to deliver inverse market performance, short market performance. And of course, in 2006, this really became in the headlines as the first ETFs were designed to deliver that kind of inverse performance. And we'll cover a lot of these a bit later. And I think it's also worth pointing out that short selling is now part of a lot of innovative strategies, whether those are hedge fund replication strategies or long-short mutual funds like the ones that Rob runs, and we'll cover some of those a bit later. So let's get right to the nut of the question. So why go short in the first place? Well, the easiest answer really is choice. So if you imagine that every potential investment in the world is nothing but a line on a chart, a pattern of returns that you could expose yourself or your clients to, when you give yourself the option to go short, you've effectively doubled the number of lines you can choose from, the number of patterns of return that you can choose from. And those choices really give you flexibility when you're constructing portfolios. If you're only ever considering the long side of every investment, then the absolute best you can ever hope to do in a truly universal downturn is just sit in cash. And even if you did that, you'd be eroded in terms of your actual buying power because of inflation, obviously. So much more realistically, I think short exposure is an incredible tool that really gives people the opportunity to manage their total portfolio risk. And last, and this is, I guess, in a sense the most obvious, short exposure does provide you with the opportunity just to gain performance that you would not get as a buy and hold investor. So now let's walk through some of the hows of how you do that. So this is sort of the most obvious example, profiting in a down market. And it's probably the simplest and the most obvious way to think about it. The short investor gets a third button on their trading terminal. So not only can they make money buying and selling, but they also get a sell short button and a cover button. And whether that's literally shorting stocks and ETFs or whether it's figuratively getting short exposure through things like options and inverse funds, that action, selling short, just simply creates opportunities for profit that aren't there otherwise. And I think it's interesting to look at the experience of a lot of advisors that I've talked to over the last couple years. So, the last 2 years have been really an antacid swilling roller coaster ride for a lot of investors and definitely every advisor that I've ever spoken with. And these really became make or break years for a lot of individual portfolio managers. And many advisors did quite well simply by moving their clients out of risky assets during the worst of the crisis and then judiciously moving them back in as the market started rewarding risk. However, the advisors I know that really blew the doors off did more than just put their cash on the sidelines. They carefully selected those assets they felt were most destined for decline, and they shorted them in one way or another, and thus they profited while most of the market was waiting. Now, I'm not suggesting that that's easy. Far from it. Warren Buffett probably has my favorite quote about this, which is, I don't see that there's a problem with shorting stocks, but it's a tough way to make a living. And, that just shows the reality that markets over time do tend to go up. That's really the fundamentals of disciplined, diversified investing, catching the long-term wave. But short selling can work. And for investors who believe that they have insight, shorting provides an avenue to profit from that insight rather than just sitting there on the sidelines. But while simply profiting from the decline of a particular stock or a particular sector is great, what I find more interesting and more exciting is the role that short selling can have in really reducing the risk of an investor's portfolio, their overall portfolio. This is where short selling really shines, managing risk and providing downside protection. So what I'm talking about here isn't limited to the idea of hedging out the exposure to a single stock. I think that's an overly simplistic way of thinking about it. I think we need to take a broader approach and think about an investor's overall wealth, their overall economic well-being. So here's an anecdote that I like to use for this. So some years ago, I was talking to an advisor in Texas, and for obvious reasons, he had quite a few oil company execs as clients. And some of them, also for obvious reasons, were quite wealthy. But he told me that often his biggest challenge as an advisor was actually getting his clients to realize just how exposed to the oil business, writ large, the entire industry, just realizing how exposed they were. And the math that he would use is that a typical executive at his practice could, they had a long career at a single company, somebody like Exxon. They made substantial cash compensation directly from that company. Back then, I'm talking years ago, they had often a defined benefit pension plan, so the liability for that was directly tied up in the fortunes of the company. And they had an incentive stock plan or an options plan, and every single one of wealth tied back to the fortunes of a single company. But even worse than that, those executives were doubly exposed because their entire earning potential was tied up in that industry. In a major downturn for the oil industry, which we've certainly seen off and on, not only could many of these sources of wealth dwindle, but the client's earning capacity would also diminish. It's not just a question of whether or not their company might go under or they might get fired. Their whole industry might no longer reward the kind of executive that client was. And what's more, in the case of a major recession in something like the oil business, it would be likely that the entire oil business-centric community would suffer, thus making other assets that client might have, such as the value of their house, be worth less as well. So once you put that kind of true economic exposure in front of somebody, simply buying a bunch of stocks that aren't stocks doesn't really seem like that much diversification. If you have the true value of somebody's participation in an industry at something like 80% of their long-term net worth, you can only do so much by, say, taking the other 20% and investing it in gold. And so this advisor's answer was simply a short position in the oil industry. Now, that may seem counterintuitive, and to some people it would probably seem downright traitorous, basically making a bet against your own company or against your own industry. But by recommending moves like this advisor was creating a very real reduction in the risk to his client's overall wealth. Now, of course, that's pretty dramatic, shorting the stock of your own industry or your own company, and that's something that many investors might balk at. But not every hedging activity needs to be quite so dramatic, and shorting provides not just a sledgehammer, but really a scalpel in tuning kinds of portfolio exposure. So let's look at a slightly more common example. So say you have a very simple view of the market, and you're in sort of a classic portfolio that has, say, 50% in U.S. large cap equities like the diamonds and 50% in the bonds, but maybe you're really uncomfortable about owning a particular stock. And the reason for that could be anything. It could be a social investing bias, like you don't want to own McDonald's in your Dow portfolio because you hate fast food. Or it might be something that's based on sort of more traditional investment insight. You're worried about the U.S. financial services sector, so you'd rather not have a big position in Bank of America. Now, as a long-only investor, your options are pretty limited. So you can really do only one of two things. You can either go try to find an ETF or a mutual fund that gives you exactly the exposure you want, just the 29 stocks you do want and not that one stock, go find that portfolio. Or you're going to have to build, monitor, and rebalance a Dow portfolio on your own, minus that one offending stock. And obviously that's not impossible, but how much easier would it be to simply buy, say, the diamonds, and put on a small short position equal to the weight of that stock in the index, just to remove the exposure to that one stock you're not happy with. Now that's a simple example, but of course you can get much more sophisticated and much more complex with it. So with ETFs, let's say you don't like financials. Well, you don't have to avoid the S&P 500 altogether. you can simply offset your long S&P 500 exposure with a small short positioning in something like XLF, or you could take a second long position in an inverse ETF tracking the financial sector. And these kinds of moves are remarkably easy to put on, and they do allow you to really fine-tune market exposure without having to go down the route of building portfolios of hundreds of stocks just to achieve those goals. So this business of going long on one hand but offsetting the long position with some short exposure starts to lead us into the really fun part of shorting, which is really the realm of hedge funds. Now, the problem when I talk about hedge funds is that really everyone means something different by it. So the very words hedge fund to some people conjure up images of Bernie Madoff or shady characters from Hollywood movies making insider trades, but really for the most part, hedge funds are in the business of providing alternative sources of return for institutional clients. That's the lion's share of most hedge fund business. And for quite a few hedge funds, their stated goal isn't actually to blow the doors off the S&P 500 or any particular market benchmark. It's actually to be market neutral, to profit solely from the expertise of the manager, not necessarily just capture the tailwind of a particular asset class. In other words, it's about controlling the risk, not just performance at any price. And this idea, being market neutral, is how this gets interesting. And so I wanted to walk through 3 different examples of market neutral strategies that you might want to be thinking about. The first, and perhaps the easiest to understand, is just simple pairs trading. And like it sounds, pairs trading means taking a long position and putting on an equal value in a short position, thus creating a kind of teeter-totter effect. If both positions go up or both positions go down, you stay even. You win on one position, you lose on the other. Now, the goal of a pairs trade is to profit from the divergence between those two stocks, generally stocks that trade together. And sometimes these are really quite obvious pairs, ones that you could come up with at any cocktail party: Coke and Pepsi, AMD and Intel, Walmart and Target. These companies that are participating in the same industry that may have particular advantage or disadvantage based on market position, based on product set, et cetera. So let's take a look at how Walmart and Target looked this morning. I just tossed this one in from this morning's trade. So this is Walmart versus Target as of this morning. And even the most cursory glance can show you that occasionally these stocks trade quite similarly, as you would expect. But they're far from perfectly in sync. There are periods where the correlations are strong, and there are periods where the correlations are quite low. And we can also see, even at a sort of simple, non-quantitative glance, that the two stocks in this period, which is just about 2 years, started out at about equal value, and they ended at about equal value. But they had a big argument along the middle about who was going to be better, and that's where pairs trading comes in. It tries to profit from this breakdown and from these arguments between stocks about who's going to be better. Now, you could sort of play pairs trading based on a hunch just by looking at the chart and saying, aha, that looks like it makes sense. But I tend to be more quantitative, and I like to take a look at the math. So for my money, I like to look at it this way, which is to look at the relative value between the two stocks. So here we see Walmart and Target in terms of relative value as of this morning. Over the 2 years, you can see that the average relationship, that middle blue line, the average relationship between the stocks was about 0.84. Or to put it another way, if you had a share of Walmart, you could trade it in for a share of Target, and you'd get about 15% left over in change. So a pairs trader would look at that relationship and look for big swings off that mean, with the idea that eventually it's going to revert to a more traditional relationship. So for instance, when that ratio fell away about a year ago down towards 0.5, or nearly 2 standard deviations off its normal movement across the mean, that created a pairs trading opportunity. And that's when a pair trader would have gone in, shorting Walmart in this case, and going long Target. And from that point on, with that trade put on about a year ago, you wouldn't really have cared what happened to the sector, right? If both stocks had gone up, you would have made no money, you would have lost no money. If both stocks went down, you'd be even as well. What you're really hoping is that the two stocks revert back to the mean. And if you go back to the price chart, you can see that that is, in this case, exactly what happened. the Walmart short in this case was probably a break even. You might have made a little money depending on when you put it on. And the target long rose back up to the level of sort of the historical mean. And you would have been isolated from the consumer retail sector as a whole. And that's really the point of pairs trading, is capturing those kinds of moves in the market. Now, there are a couple of caveats here. Pairs trading is an interesting in a trendless market, or to make money from a sector you might not particularly want to be long in, but it's not without risks. You are putting on two positions, and like any two positions you put on, you've got two opportunities to be wrong. You can be wrong in both directions, and there have been cases, not just a few, where historic relationships between stocks break down and they change permanently. New baselines are established. New winners and losers emerge in a particular industry. That does happen all the time. The second major caveat is, even though a pairs trade may look good and it may make sense sort of at the cocktail party napkin level, it may not always make sense once you put it into a spreadsheet, which is why most pairs traders approach this in a fairly quantitative way. And in a fairly rigorous way, not just sort of based on a knee-jerk assessment. So this core premise, going long and short, is also behind an increasingly popular strategy, commonly called 130-30 or long-short extension. And it's not something that most individual investors are going to try to construct on their own, but there are now ETF products out there, mutual fund products out there, that mimic the patterns of returns in these strategies. So I think it's worth touching on because shorting is a key component into how they work. So to understand how 130-30 works, let's imagine that you are, or let's imagine a hypothetical large cap equity manager, and she's got $100 to manage, and her acceptable universe is 10 stocks. So she does her analysis and she decides, I really like 5 of these stocks. 2 of these stocks are absolute dogs, and I couldn't care about the rest. Well, if she's managing under a traditional mandate, she really only has one option, which is she takes her $100 and she buys those 5 stocks, and she's done. That's it. That's the maximum amount of juice she's going to be able to get out of her analysis of this 10-stock universe. But if she's comfortable with shorting, she does have more options than that. She can short those 2 stocks that she really hates, and generally in the industry, the maximum short is around 30%, which really has to do with margin requirements and some regulatory issues, which aren't necessarily all that important for this discussion. But when she does short those stocks, she now has $30 in proceeds from that short sale. And rather than just sitting on that $30, she can take that and go back and invest it in the stocks that she likes. So what she ends up with is a portfolio that's $130 long, even though she only started with $100, and it's $30 short, still within that universe of 10 stocks. And if her analysis was right, she'll profit both from the excess investment in those 5 good stocks and from the decline in those 2 bad stocks. And she'll generate a return greater than she would have if she'd had to be over at the beginning of the slide, only investing her $100 in the long portfolio. You can extend this idea one step further in what are called portable alpha strategies. And this is the last core strategy I'm going to cover. And again, it's not one that most investors are probably going to implement on their own, but it is a concept that a sophisticated investor can use when evaluating sort of a stable of active managers that they may be looking at. So imagine we have an investment with a traditional active equity manager, large cap U.S. equity manager, one whose performance you're quite happy with. Now, you have a bit of a problem. Maybe your client is older, they're heading into retirement, and you know that they need to start allocating more into bonds. Right? You don't want to have them 100% invested with this active manager. So normally you would basically just have to go sell. You would have to allocate less to this manager. But you don't necessarily want to do that if you genuinely believe that that manager is going to produce alpha over and over again. What you would like to do is be able to capture that, but not have all this exposure to, say, the S&P 500. So shorting gives you the option of doing that. Instead of selling shares in this fund, you can simply short that manager's benchmark. If you believe he's going to continue to beat the S&P 500, you short the S&P 500. Now, you'll profit from the manager's insight regardless of what happens to the U.S. equity market. Now, of course, Many managers' performance is serial correlated, so perhaps they're going to perform better in one kind of market or another. Those are more complex issues, and this isn't something that you do willy-nilly, and it's not for the faint of heart. But it does allow you to extract manager performance from the universe that they're investing in. Now, once you've shorted that S&P 500, you can now turn around and invest it. So you can go get long the bonds that you necessarily want to be in. And the end result is that you've created essentially a synthetic portfolio. You've ported the alpha from the active manager onto new beta, the bond market returns that you really wanted as the core of the portfolio. And that's how you get the name, portable alpha. So those last three topics, quantitative pairs trading, long short, portable alpha, I admit those get pretty deep into the rabbit hole of finance, and there are reams and reams of academic papers on all three. And if anybody's interested in digging into the math, I'd be happy to send people a reading list if you drop me an email, which I'll put up on the last slide of the webinar. But in the interest of time, what I'd like to do is take a quick rundown on some of the tools that investors have at their disposal to implement strategies like this and other ones which we'll talk about in Q&A. So the oldest way to get short exposure is actually the most complicated, which is to simply short stocks. So when looking at different options, I like to look at pattern of return charts, which basically show you what would happen if you took a position with a stock at a price of $100, sort of in the middle of the chart, and then the stock goes up or down to the left or the right. This is the pattern you get when you just short a stock. Now, just is an interesting word because shorting is sometimes easier said than done. You need, at a minimum, a margin account with your broker, but you also have to have access to the security you're trying to sell short. You need to locate that stock. You need to borrow it. Now, sometimes that's very easy. Pretty much anybody could short Microsoft all day long. Most S&P 500 names are very shortable. But sometimes it's quite literally impossible. There are many, many securities that are simply not available to borrow. So your universe is a bit limited in terms of how you're going to be able to do that, and it's not necessarily easy. Once you've shorted the stock, however, you pocket the proceeds essentially, and as the stock price declines, the amount of those proceeds you get to keep goes up until theoretically the company goes bankrupt and you can keep it all. Practical term rarely happens. Of course, things can go the other way too, and you'll keep losing money no matter how high the stock goes. Obviously, if the stock goes from 100 to 200, you're on the hook for that. You're on the hook for that performance because you owe somebody those shares. So the loss of a flat short position is theoretically unlimited. Now, in reality, of course, nobody waits forever to cover their shorts, and eventually people do cry uncle. But it's worth noting that the theoretical risk is effectively unlimited. A similar pattern of returns can be achieved in the options market, the biggest caveat being that you need an options account, obviously, which many people don't have. In this case, instead of shorting our stock at 100, we simply buy a put option, that is the right to sell that stock at some future date for $100. Here we'll make somewhat close to the same pattern of returns as a traditional short, but we'll pay a premium to buy that put, which we never get back. But that is also our entire loss. We'll never lose any more money than the value of the put that we bought. And it's also going to reduce the value of any gain that we make by the same amount. The flip side of that, just briefly, is you can sell the call option. This has the advantage of immediately locking in a very small profit, just that same premium that you're going to collect, but the liability can be substantial if the option goes against you. It's worth pointing out that in both of these cases in options, it's a little more complicated than this because you have to pick exactly what contract you want to be in. Do you want to be in next month's contract, 6 months from now, next year? And you have to pick the price at which you want the option to strike. It's not like shorting where you're going to short it at the price that the market will give you. You have a range of options that you can choose from, pardon the pun, and you have to pick the one that you think is quote-unquote right. Now, what the right option is and what the right premium to pay or collect is the subject of yet another entire branch of academic finance. And it's not really for the uninitiated or the faint of heart, but it is an option that's available to investors. And last but not least, there are inverse ETNs and ETFs. Now, these exchange-traded products have created an awful lot of headlines, and they've also generated a tremendous amount of trading value and trading volume. They provide a similar pattern of returns to shorting a stock, but with a few very critical differences. The most critical of which is that they provide daily returns. They're not generally designed to be long-term holds. They need to be monitored and rebalanced. So if you hold for more than a day, you're going to be monitoring and rebalancing that position if you want to mimic that pure short position's pattern of returns. The second key difference is that your downside is limited. Because you buy the inverse ETF, you obviously can never lose more than the 100% you put into that investment. And the last key difference is, frankly, just one of convenience. You can trade an inverse ETF in any brokerage account for the most part without margin issues, and the costs of borrowing to be short are effectively baked into the product. Now, before we move on to Q&A, I did want to just hit a couple of myths about these inverse ETFs, because I can see we've already gotten a bunch of questions on them, and I'm sure we'll get a bunch more. There are a lot of myths surrounding inverse ETFs, and probably the first one is the most dangerous, which is that inverse ETFs deliver negative something % of an index's long-term return. Well, that's just frankly wrong. They deliver X % of a daily return of a benchmark index. Now, the only thing that's different there is the holding period. Now, the other myths surrounding inverse funds, I think, are just as pernicious and probably more wrong. One that we hear all the time is that they have huge tracking error. Well, actually, they don't. The data suggests that, by and large, inverse ETFs do exactly what they're supposed to do. They provide tightly tracking daily negative returns to a benchmark. The problem is people are often trying to evaluate them against a different benchmark, a long-term benchmark, which is frankly no different than trying to figure out what the tracking error between stocks and bonds is. It's sort of a bit of a nonsensical question. The third big myth is that people are using them incorrectly. Well, it's easy to understand where this one comes from because it's certainly possible to use them incorrectly. But if you actually look at the trading patterns, the evidence actually is against this one as well. Most of the volume in ETFs would suggest that people are holding these for shorter term periods. And of course, that doesn't mean they aren't being used wrong by some people, but by and large, the evidence is they're being used correctly and effectively. The fourth myth, frankly, is that they're tax efficient. Now, that's one that's a bit tricky. Short selling is rarely a tax efficient activity. It is true that in 2008, there were some substantial distributions from inverse ETFs and leveraged ETFs. In 2009, for the most part, there were going to be practically none. But of course, if you're actively monitoring and rebalancing a position, you're creating your own taxable events, regardless of distributions coming from the ETFs themselves. And frankly, there are very few investors I know that are putting on short positions for a long enough period of time that there's going to be anything but trading gains on these anyway. And then the last position is that somehow these products are inherently poisonous. We certainly saw a lot of this in the spring. And I don't want to duck the issue. They are powerful tools. And just like handing somebody a scalpel or a chainsaw, people get hurt if they're not careful and if they don't know what they're doing. But I think that's frankly the case with almost every investment. It's the case with just going long. It's the case with, frankly, buying a CD if there are other options available to you. And making the wrong decision causes people pain. And I think that that's the same here. You know, there is no such thing as a free lunch. So this has been a bit of a drink from a fire hose. We've covered a lot of ground, and we've introduced a lot of new concepts. While the implementation and the products are innovative, I think it is important to walk away remembering how much a part of the market short selling has been and will continue to be. You know, in terms of thinking about how much shorting activity is going on, you know, the New York Stock Exchange reports short interest, which is a way of calculating how many days it would take to essentially cover all the shorts on the New York Stock Exchange. And that's sort of been hovering around 2 to 4 days for quite a long time, with a few spikes, I think, at obvious places during the crisis. You know, that spikes up about 10. But it is a fairly consistent part of the market. I think it's also worth pointing out that it's understandable that this is seen as a somewhat fringe activity by some people. You know, being a short seller is a bit like being the guy at the craps table who's betting against the person with the dice. You know, almost everybody else out there is betting for things to go up. They're betting on that shooter to win. So being the only guy standing at the don't pass line can frankly get a bit lonely. But I think that we'd be well served not to be scared off by that and to not miss the opportunities. So with that, I'd like to open up the line and bring our panelists in. As a reminder, we have Joanne Hill, the head of investment strategy for the ProFunds Group. We have Tim Collins, founder and principal at Tangle Trade Management and contributor to TheStreet.com, and Rob Stein, portfolio manager for the Astra Longshore ETF Fund. I'd remind everyone that you can submit questions at any time by entering them into the Q&A window on your screen, and we'll collate those and get those to the panelists. But I thought maybe I'd kick off, Joanne, starting with you, and just sort of ask you a little bit about the rise of leveraged and inverse ETFs. I mean, there's no question they've caught on, but I'd love to talk a little bit about fund flows. You know, back in the old days, the only metric we really had for gauging investor sentiment was either the price that things were in the market, you know, whether something was, you know, had a high PE or a low PE, and then the volume of shares that were sold short, the short interest. And with the leveraged and inverse products, it seems like we've got this great new window on the day-to-day world. So what is that telling us? What are we seeing there?
Great. Yeah, definitely. I think that ETFs in general have been very heavily used for expressing short views in a lot of the strategies that you talked about, and certainly inverse ETFs are a big part of that. But even going back to the early days of the SPDR and some of the other broad-based index ETFs, we see quite a level of short interest in them as well. And I think that shorting with indexes in ETFs is a much more widely used practice than shorting individual stocks, because people have macro views. They have reasons to want to reduce risk or express negative views in a shorter time frame, to perhaps underweight a particular segment or area of the market. Also, what is a pairs trading in a stock, Walmart, Target, although that might appeal to just a small portion of investors, the ability to go, for example, long mid-cap, short, small-cap U.S. or EFA, an international index, you can easily think of pairs trades across market segments or asset classes that would be a very interesting part of a portfolio. And also, I think it's important to realize that indexes are, generally speaking, less risky than individual stocks.
Sure,
so some of the risks of having a short position in terms of the typical daily move might be a little bit less. But with respect specifically to leveraged and inverse fund flows, I mean, if we look at the assets today of the industry, it's about $31 billion in total. And one of the things we follow is what percent are short and long of those assets, because it actually does move quite a bit over time, and I'll give you some color on that in a minute. So right now, there's 20 billion short, 63% of the combination of leverage and inverse in the short side. And, you know, that's been the dominant thing, using these products more for shorting than for getting leveraged long positions. But if we go back and we look through 2008, we see that definitely these investors appear to be knowledgeable, sophisticated market participants that are using these products to express market views and manage risk. So, for example, the peak in shorting in the portion that's short came in the summer and fall of 2008, and between September 2008 and February of this year, when we had the equity market bottom, we saw an increase in flows into leveraged long. And actually, in February, the ratio was 50-50. There was an equal amount of long and short assets. And since that time, you know, from March through November, we've seen inverse assets go from 50% to 63% of total assets. And just to drill down a little bit on with some of the numbers from ProShares, this year we've had, roughly speaking, $9 billion of net flows market adjusted. But if we look behind the curtain, it turns out that we've had something like $15 billion of flows into our short funds and $6 billion of outflows in our long funds. So during the time that investors have been taking on a little bit more risk, in long-only products, it seems like there is an increase in inverse asset activity. Also, when we look at the flows,
hey, Joanne.
Yeah.
It's Rob. Do you think that could be used as an indicator for where the market might be going? Is it like a sentiment indicator? Do you believe?
I think yeah. I mean, I think it's definitely a sentiment indicator to follow. With these sort of two data points, looks like it might be contemporaneous, maybe a little predictive, but we only have two data points, so we can't really say anything definitive there. But I just will add one more statistic, and that is that important. I know everybody has seen the big flows into bond mutual funds and ETFs this year, but we've actually seen almost $3 billion of flows into inverse product, Treasury index products, and so there's also some hedging or views, going on that investors are concerned with rising interest rates. So those are some of the themes you can follow if you follow ETF flow, inverse and leverage ETF flows.
Interesting. So Rob, maybe you could expand on that a little bit. I mean, clearly, as it says in the name of your primary fund, you're going long and short using ETFs in your mutual fund. How are you making your decisions there? What's your approach in creating the sort of long and short exposure?
Sure, and we have an economic approach to looking at the data. We're economists by training and education. I actually worked at the Federal Reserve under the Volcker years, and we believe there's four distinct economic cycles: expansion, peaks, contractions, and troughs. And what we try to do is find sectors that correlate very nicely with an ETF, so that if you have an opinion on the sector, there's a tool that will match that sector, and we will go long when we identify an expansion and short the sectors that we believe are in contractions, and try to create alpha by getting it right more than we get it wrong. For us, we use employment trends, and that's just our tool, and there's a lot of other very, very useful tools, but as a sector starts to lose jobs, we match it up in the employment report with the sector, try to find an ETF that matches, that moves as that sector moves, and then we'll go either long or short, and try to be a little on the balanced side. We won't be just outright naked short, and we like the inverse products quite a bit too for getting short exposure for a variety of reasons and benefit. First, you have no issue in qualified accounts, retirement accounts, 401ks, which often frown upon shorting, so the inverse ETF allows for exposure to that. But also, the more you're wrong, the less it hurts on an inverse product because of how it rebalances. A naked short, as conventional wisdom goes, you can lose infinity, right? It can only go to zero, but it could go up to infinity. Never really seen a stock go to infinity, but that's sort of the concern. But with an inverse product, it keeps cutting its exposure. If you had 30% in the, you pick the inverse product, you want the QID, the SH, whichever one. As the market moves up, this thing gets to be a smaller part of your portfolio, and it hurts less when you're wrong, as I think the percentage weighting on a short might actually hurt you more in that regard. But for us, we use economic data, and then we're agnostic to up or down. If you're going to make 10%, I don't care if it's because you bought something that went up 10% or if you sold something that went down 10%. It's still 10% more.
Right. I think that's an interesting point. That it's a subtlety, but I think it's a real one. That inverse ETFs and inverse mutual funds have that sort of virtual sense of taking money off the table if it's not working and putting money on the table if it is working, which is the opposite of what happens with a short portfolio, right? If you're right about your short and your short goes down by half, well, your nominal exposure is also half. Now, you've booked that as profit, but if you want to keep a certain percentage, a certain portfolio allocation short, you have to do the same kind of maintenance on the short position that you would do on an inverse position to keep it in line with some sort of portfolio metric you were setting for yourself. I think that's an interesting point. Rob, Tim, I wanted to turn to you because, in one of your columns at TheStreet.com, you referred to yourself as a leverage and inverse ETF junkie, and we actually have a question from the audience that I think goes directly to some of the things you were talking about in those columns, which is the issue of actually doing things like shorting the inverse funds versus going long the long funds. So I'm just sort of curious, when you're looking for the trading dynamics of these things, how are you approaching leverage and inverse? Are you looking for cute little arbitrage like that, or are you making more fundamental plays?
I guess if Rob's the economist, I'm a little bit more like the party guy when it comes to leverage ETFs. Generally, I'm not on the fundamental side. I am much more on the technical side, but I am certainly on the arbitrage side. Whenever I'm using the leveraged ETFs, especially, I'm looking for different. I don't want to call it chinks in the armor, but I try to pay attention to how they operate together, how the underlying options operate along with those. And if there's any possible scenario to use them, I'm going to test it, and that's what I've been writing about, is different theories that have been thrown out on a lot of popular sites of, all you got to do this is sit back and collect the money, which in most cases is true for about the blink of an eye until the market gets a trending direction here. So most of the time what I'm doing is I'm trading them on a technical level. One key I would really like to mention is when we're trading these and we're looking at a technical aspect, you don't want to be focusing in on the leveraged ETF itself. You want to be focused on the underlying, simply because in its purest essence, it's a derivative. And very rarely have I seen technicals that work well on a derivative. So what we're doing is we're looking at, if we're looking at QLD, we're going to be looking at the QQQQ first, and then applying technical applications from the QQQ, from the cubes, across to the QLD or the QID. Now, the other question comes, do you short the lever? Do you go long, the inverse? What do you want to look at? And I classify that into time frames. If you're looking at a shorter time frame, I would tend to want to use the compounding to my advantage. So if I'm, from a technical aspect, looking at a breakout, and I'm thinking it's going to be long, I'm going to be looking at the QLD and going along that aspect. If I'm playing more along the lines of volatility or up and down movement in the market, that's when I'm going to look at a short position, because you can take advantage of the volatility decay. And, in most of those cases, though, and volatility decay is the impact of the daily resets on the compounding. But really what it comes down to is in using these products, you have to know them, you have to study them, you have to understand them. They're very, very powerful, but extremely useful. You can set up strategies that I don't think you can find with any other products that are readily available to the retail investor that's out there.
Right. Tim, do you find sometimes you get the direction right, but because the instrument you picked, you don't get the same bang out of it? I've noticed scenarios where you can short the cubes and you can purchase at the same time the inverse product, and a week later the market's down, your cube position's down, but your inverse ETF is also down.
Well, and we learned that way back in the day when we first started messing around with these. I've actually been utilizing them since they first appeared. Whenever we set up a position like that, we will actually do the opposite. If we were directional and we thought, we wanted to be long the cubes, when we do some type of arbitrage play, we would be long the cubes. But in that case, if I'm afraid it's going to be a volatile time frame, I'm going to take a short position in the QLD. Now, I might skew it a little bit differently than just doing a 1-to-1 or a 2-to-1. My direct correct. I want to make sure the compounding doesn't hurt me very much. But generally, we're doing most of this stuff through the options market so that we're taking advantage when we set up these arbitrage of volatility decay along with time decay, which is one of the strange things that's out there that's available to you. And then also, we talked about the ability to short these. The interest rates are pretty high on a lot of these leveraged ETFs and the ability to borrow them, which I think Dave touched on. Not only do you have to pay attention to the ability to go out and get shares, but you have to look at any interest rates that are being charged. With the impact of those interest rates is actually made a little offset in the put-call parity because you have to factor in, if more people are shorting these, when you look at put-call parity, you have to take into account the interest rate. So it looks like, hey, I can do a caller here and make money by shorting and buying and selling a put, and ironically you can't because the interest rate charge during that holding period is equal to the amount of money that you're going to make. What ends up happening there, though, is that creates a different type of arbitrage, and that creates the arbitrage where you can use options along with the time decay, and you can harvest actually the interest rate that's being charged to other people by just doing a different setup. And those are the type of strategies that I write about and try to teach about and talk to people about.
So we have a bunch of questions that I think I'm going to sort of roll up into a kind of response question for you on that one, Tim, which is that for somebody who is not an active participant in the options market, what you just said could easily sound like a whole lot of Greek, right? And so I think there's one question that I think is legitimate is, with the presence of all of these different ways of playing, with the options market, with the inverse ETF directly, do smaller investors actually stand much of a chance, or are the arbitrageurs out there so able to game the system that there's noise introduced into this process of shorting? I mean, how would you respond to that?
Actually, maybe I can jump in on that.
Sure, please.
I think that, I think what you have gone through is a number of different ways of shorting and doing relative trades for both sophisticated as well as for sophisticated investors and for those that want very customized payoffs like options would provide. But I think what people like Tim in the marketplace do is actually help get consistent pricing across these different ways of going short, given their different features. So I think that if we go back to the simplest mechanism to do this is really just the short ETF or inverse ETF. I think those are among the easiest to understand, although it's very important, of course, to keep in mind that the inverse has that daily objective. And so if you get a volatile market, you might want to consider whether you want to be buying it or shorting it. But
or just using the single inverse is the powerful tool that people are passing off.
Right.
It's worth pointing out that not all of these short funds, or not all these inverse funds, have any leverage at all.
Yeah, and those are the ones the retail investor I think can use quite well. And also, I don't think the arbitrage is having any negative impact or any drag down simply because it's just balancing out. You're talking about very small price inefficiencies that are being balanced out. It's nothing that's altering or swaying the market.
Right. So Joanne, we've had a couple questions along these lines, and I know you've done a lot of research, so I'd love for you to a 2-minute answer here. We've had quite a few people say something to the effect of, if my only option for shorting is to essentially take positions in a long product, i.e. an inverse ETF that I can buy in a traditional account that doesn't normally allow shorting.
Right.
But the way to achieve longer-term short exposure is to do this process of assessing the position and rebalancing. How is an investor to monitor that so that they don't get killed either in taxes or transaction costs? What's the mental algebra people should be going through to make those assessments?
Well, I think most people follow a practice. So the basic idea here is that if you want to achieve a multiple, a -2, -3, -1 multiple of index returns over time, that you can use the inverse product, but you do need to monitor it and rebalance at either based on a percentage move or a regular period of time, let's just say a week. And so most people do this actually in their broad portfolio, usually once a quarter or once a year. They'll look and see, right, if their positions are above where their target is or below, and they'll bring it back in line. And this is really all you need to do here as well. You just look and see if your inverse fund position is kind of below where the index has moved to that point in time, and if it is, you add to the position, and if it's ahead of it, you take profits. So it's not that complicated, and you know the size of the trading. I mean, it can add. It depends on the volatility of the market, but you know, when we studied this, we looked at typical trade sizes of 5% of the portfolio, which you know you might have to do every couple weeks. But this is. You know, this is one route that investors have if they do want to take these daily objective products and convert them to something that can be good for a longer horizon.
Right. You know,
Joanne hit one. Sorry, go ahead, Rob.
I was going to say that's what we do in our fund, and we're very diligent about it because you sometimes are a little hesitant to buy something after it's gone down, the rebalancing part of it, and you end up favoring one particular side. People seem to like to take profit more often, and it's really, as Joanne was pointing out, about keeping the possession size equal. And so you have to be as diligent of buying into a losing position, maybe even as you are into selling, and you can replicate the return of the index. It's just math.
Right, right, and it's worth pointing out that if you truly do this, if you truly did this at the end of every single day, you would come extraordinarily close to that long-term return you were trying to achieve.
Right.
Obviously, the trade-off there is balancing out both any tax implications and the trading costs of doing that, so that you're benefiting yourself, not just grinding.
Yeah, there are a few studies out there that are showing though that you know, doing something just based on the calendar is not the most efficient manner. And what Joanne talked about, and the same thing with Rob, is actually a review on a 1 to 2 week scale with a set trigger, like a trigger percentage of anywhere from 5 to 20%, just depending on whether you're using leverage or not, is the optimal way to rebalance. And it actually does not end up involving that many more trades than just do it every 3 months regardless.
Right.
So if people are worried about right, you actually don't end up trading that much more. You end up trading 4 to 6 times a year on a typical year, as opposed to quarterly rebalancing, and you're going to hit your targets.
Right.
You're going to hit the highs and lows much more often than you will just by picking a calendar date. I mean, there's no logic in the calendar date.
Right. Well, unfortunately,
so Joanne's point should be well taken.
Right. Yeah, I think so too. I mean, I think the conclusion that I would draw here from all of you is that, again, this is not a fire and forget strategy, shorting in general. This is a taking a position and monitoring that position. You're not going to put on a short position and come back and look at it 6 months later. That's a pretty safe precedent. I think that's going to do it for our time today. Unfortunately, that does bring us to the end of the session. I'd like to thank Joanne, Tim, and Rob for joining us today, and to ProFunds for sponsoring our session. For more information on some of the strategies discussed here, please do check out some of the educational materials available at indexuniverse.com or ProShares or ProFunds.com. I'm also happy to point people. If they want some deeper materials to dig into, you can drop me an email at dnadig@indexuniverse.com. For those of you who are eligible for CFP continuing education credits, the information you need is right here on the screen, and we'll leave this here for a few minutes after we close. We'll also be emailing this information out along with the appropriate forms for SEMA credits when we post the replay of this webinar within a few days. So thank you all for coming. Thanks to my panelists, and we hope to see you at future installments of the indexuniverse.com webinar series. Good afternoon.